Silver just crashed 2% today to $75 an ounce. But here is what nobody told you. 2 weeks ago, this metal was at $121. That is a 38% collapse in 14 days. And the story behind why it happened reveals something institutions do not want retail investors to understand about how markets actually work. Welcome to Capital Anchor. If you are new here, I cut through the noise and show you what is actually happening in markets while everyone else is distracted. Subscribe right now, because what I am about to show you could change how you see every single price move from here forward. Let me give you the timeline. January 29th, 2026. Silver hits an all-time high of $121 per ounce, a 278% gain in exactly 1 year. Retail investors are euphoric. Social media is flooded with predictions of $200 silver. Then, 30 hours later, everything reverses. By January 30th, silver crashes to an intraday low of $74.80, a 38% drop in less than 2 days. Gold drops 12% in the same window. Together, they erase $7 trillion in combined market value in a single session. This is the largest one-day precious metals crash since 1980. The Hunt brothers tried to corner the silver market that year. Regulators crushed them by raising margin requirements. Sound familiar? Because the exact same playbook just got deployed again. Here is what actually happened. On the morning of January 30th, President Trump announced Kevin Warsh as his pick for the next Federal Reserve chair. Markets immediately understood what this meant. Warsh is an inflation hawk. He warned about inflation risks during his previous term as Fed governor in 2006. He advocates for the Federal Reserve to shrink its balance sheet. This is the opposite of what retail expected. Most investors thought Trump would pick someone dovish, someone who would print money and weaken the dollar. A weaker dollar makes precious metals more expensive. It drives safe haven demand. But Warsh signals the exact opposite policy direction. The dollar spiked. Commodity currencies like the Australian dollar and Swedish krona collapsed, and silver got obliterated. But the Fed chair announcement alone does not explain a 38% crash. There is a hidden mechanism most people completely miss. Think of the futures market like a seesaw. On one side, you have speculators using leverage. They control massive positions with tiny amounts of cash. On the other side, you have clearinghouses that manage risk. When prices surge too fast, the seesaw tips dangerously. The clearinghouse has to rebalance it before the whole system breaks. How do they rebalance? By raising margin requirements. Here is the critical detail. On December 29, 2025, the CME Group raised margin requirements for silver futures twice in 1 week. Initial margin jumped to $25,000 per contract. A standard silver contract controls 5,000 ounces. At $75 per ounce, that is $375,000 in notional value. This creates 15-to-1 leverage. But when prices were at $121, that same contract was worth $605,000, with only $25,000 in margin. That is 24-to-1 leverage. The CME moved to a percentage-based margin system in January 2026. Maintenance margins jumped to 15% for standard positions. Some positions required 16.5% for heightened risk. This effectively ended the era of cheap paper speculation. Traders who rode silver from $30 to $121 suddenly faced a binary choice: deposit massive amounts of additional cash to meet the new margin requirements, or close positions immediately. Most could not deposit more cash, so they had to sell, and when everyone sells at the same time, liquidity disappears. Bid-ask spreads widen, prices collapse faster than anyone can react. This is called a forced liquidation event. It is mechanical, not fundamental. Luigi De Bellis, head of research at Equita, called it exactly what it was: a liquidity event. Sales were amplified by risk limits, margin calls, and volatility control strategies. Silver, being thinner and more speculative than gold, magnified the stress. Positions had become especially crowded. Kirsten Hotner, head of commodities at Vontobel, described it as a classic deleveraging shock. Extended speculative positions were forced out of a crowded momentum trade. Stop losses and margin calls cascaded through the market. One sale triggered another, then another, then another. Within hours, the entire structure collapsed. Now here is the part that should make you pay attention. The crash happened on January 30th, the final trading day of the month. February 1st fell on a Saturday. Futures markets would not reopen until Sunday evening. Traders holding January contracts or facing month-end margin requirements had no ability to adjust positions over the weekend. They were trapped. Imagine owing the bank $300,000 on a house worth $200,000 and being forced to sell it right now. You would accept any price just to pay off the debt. That is what happened to leveraged silver traders on January 30th. Let me break down the 3 reasons this crash was inevitable. Reason number 1. Silver had become aggressively overbought. In January alone, silver surged 68%. Gold rose 29% in the same period. Suki Cooper, who leads global commodities research at Standard Chartered, said she was not surprised by the sell-off. Both metals were trading in aggressively overbought territory in early 2026. Both markets were due a correction, particularly to maintain the long-term uptrend. Technical indicators were screaming. April silver futures formed a bearish key reversal pattern on the daily chart. This is a signal that often indicates a market top. Neil Welsh, head of metals at Britannia Global Markets, explained it perfectly. For precious metals, the pullback is probably not unexpected, given the speed and magnitude of January's rally. Gold and silver had become technically overextended, with gains of nearly 20% and over 40% respectively. Reason number 2. Speculative positioning was extremely crowded. Ole Hansen, head of commodity strategy at Saxo Bank, described how the rapid gains had fundamentally altered market conditions. Market makers grew reluctant to take and hold risk. This resulted in thinner liquidity and wider bid-ask spreads. Hansen said the move today in isolation is pretty crazy. But if we zoom out just 1 week, it is unfortunately perfectly normal for a gold market that has gone from being the adult in the room to behaving like an angry teenager. Just like silver, when everyone is positioned the same way, there is nobody left to buy. The only direction is down. Reason number 3. A fake news catalyst accelerated the panic. On January 29th, Reuters published an exclusive report claiming the U.S. government would end strategic metals support. The entire rare earth market crashed on this report. Then the Energy Department issued a statement after the story was published. The article was false and relies on unnamed sources that are either misinformed or deliberately misleading. But by then, the damage was done. Algorithmic trading systems had already triggered mass selling across the entire commodity complex. Silver, gold, platinum, and palladium all collapsed together. Max Bonchkovsky, an independent analyst and trader, called it a slaughterhouse. The precious metals market turned into a slaughterhouse when in just 48 hours, silver crashed from historic peaks above $121 to $76, posting a nearly 33% decline. Now here is the big player versus retail disconnect. While retail investors were chasing silver to $121, institutions were quietly preparing for this exact scenario. Peter Brandt, a 50-year commodities trading veteran, warned about a parabolic blow-off top before the crash. He compared the current spike to 2011's top, which he also accurately predicted. Marko Kolanovic, former JPMorgan strategist inducted into the Institutional Investor Hall of Fame, predicted a 50% reckoning for the metal. Both of them issued these warnings in late January, right before the crash. Then, after the crash, both switched their stance. They went from bearish to tactically bullish. Why? Because they understand something retail does not. These crashes are designed to flush out weak hands. Institutions do not buy at the top. They buy after the forced liquidation event. When retail is panicking and selling at any price, institutions step in and accumulate. While you were watching, silver hit $121 and thinking it would go to $200, they were watching margin requirements and liquidity conditions. They knew what was coming, and they positioned accordingly. The CME Group's margin hike was not random. It was a deliberate move to prevent a clearinghouse collapse, but it also guaranteed that leveraged speculators would be wiped out. The Shanghai Futures Exchange did the same thing. They expanded daily price limits for copper and aluminum futures to 9%. They raised margin requirements for speculative positions throughout January 2026. This was coordinated. Central banks and major exchanges do not let retail speculators destabilize the entire system. They pull the rug. They always have. They always will. Here is what most people completely miss.
Now here is where it gets interesting. This exact pattern has happened before. Let me take you back to April 2013.
Gold was trading at $1,470 per ounce. Silver was at $20.70.50. Then, in 2 trading sessions, gold crashed 13%. Silver dropped 19%. The entire precious metals complex collapsed. Margin requirements were raised, leveraged positions were liquidated, retail investors panicked and sold. Sound familiar? But here is what happened next. Gold bottomed at $1,180 in December 2013. Then it spent 7 years consolidating, building a base. In 2020, gold broke above $2,000. By 2024, it reached $3,500. Today, in February 2026, gold is trading near $4,800. That is a 306% gain from the 2013 crash low. Silver followed the same pattern. After the 2013 crash, silver bottomed at $13.50 in 2015. It consolidated for 5 years. Then in 2020, it broke above $29.
By January 2025, silver was at $32. 1 year later, it hit $121. That is a 796% gain from the 2015 low.
The crashes do not end the bull market. They reset the market structure. They flush out leverage. They transfer assets from weak hands to strong hands. Then, the fundamentals reassert themselves, and prices resume their uptrend. So, what are the fundamentals today? What has not changed despite this crash? Let me give you 4 structural factors. First, central bank gold buying remains at record levels. The World Gold Council reported 1,037 tons of net purchases in 2024. That is the second highest annual total on record. China, India, Turkey, and Poland are leading buyers. They are not buying for speculation. They are buying to diversify away from dollar reserves. This trend has accelerated under Trump's trade war policies. Second, the silver supply deficit is worsening. The Silver Institute projects a 215 million ounce supply deficit in 2026.
That is the 4th consecutive year of deficits. Total above-ground inventories are declining. COMEX registered silver inventories dropped to 37 million ounces in January 2026.
That is a 12-year low. Meanwhile, industrial demand for silver in solar panels and electronics continues to surge. China alone is installing 400 gigawatts of solar capacity in 2026. Each gigawatt requires approximately 100,000 ounces of silver. Third, de-dollarization is accelerating globally. BRICS nations are expanding their commodity-backed trade settlements. Russia and Iran are settling oil transactions in gold-backed instruments. Saudi Arabia has ended its 50-year petrodollar exclusivity agreement. These are not speculative moves.
These are structural shifts in the global monetary system. Fourth, Western government debt continues to spiral. U.S. federal debt crossed $37 trillion in January 2026.
Debt to GDP is now 138%. European Union debt levels remain above 90% of GDP. Japan's debt to GDP ratio exceeds 260%. Historically, precious metals rally when confidence in fiat currencies declines. That confidence is eroding. These 4 factors have not changed.
The January 30th crash was a leverage flush, not a fundamental reversal. Now let me give you my on-the-record prediction.
Silver will retest $100 per ounce by June 30th, 2026. Screenshot this. Here is why. The forced liquidation event has reset market positioning. Speculative excess has been purged. Margin requirements are now at sustainable levels. The CME's percentage-based margin system prevents another parabolic spike. But it also means the next rally will be driven by physical demand, not paper speculation. And physical demand is accelerating. U.S. Mint Silver Eagle sales surged 42% in January 2026 compared to December 2025. Premiums on physical silver bars jumped from $3 per ounce to $8 per ounce. Delivery delays are stretching to 6 weeks. This is not a bearish signal. This is accumulation. The smart money is buying physical metal at discounted prices, while retail is still traumatized by the crash. Let me give you 3 scenarios with probabilities.
Scenario 1. Silver consolidates between $70 and $85 through March, then breaks above $90 in April as physical tightness becomes undeniable.
Probability 60%. This is the base case. Markets need time to digest the volatility, but the supply deficit will force prices higher. Scenario 2. Geopolitical escalation triggers immediate safe haven demand. Reuters reported on February 14th that U.S. military is preparing for sustained operations against Iran. If Trump orders an attack, silver could spike back above $100 within weeks. Probability 30%. This is the bullish scenario. Geopolitical risk is extremely elevated right now. Scenario 3. A broader market crash drags all assets lower. If the S&P 500 drops 20%, silver could retest $60. Probability 10%.
This is the bearish scenario. But even in this case, the fundamental supply deficit would drive a recovery. Now let me give you practical takeaways by viewer type.
If you are holding physical silver right now, do nothing. Your metal did not evaporate. You still own the same number of ounces. The paper price crashed, but your physical holdings are intact. Wait for the supply tightness to push prices back up.
If you are using leverage or trading silver futures, cut your position size immediately. The new margin requirements make aggressive leverage unsustainable.
Focus on longer-term positions with minimal leverage. Do not try to day trade this volatility. If you are sitting on the sidelines with cash, start dollar-cost averaging into physical silver. Buy small amounts every week between now and March. Target an average entry around $75 to $80. Avoid paper products like ETFs during this volatile period. If you bought silver at $110 and are underwater, you have 2 choices. Sell now and accept the loss, or hold for 6 months and let the fundamentals work. Based on the supply deficit, I would hold, but only if you can tolerate the volatility. What should you watch going forward? 3 specific indicators. First, watch COMEX registered silver inventories. These are published weekly. If they drop below 30 million ounces, we are in a crisis. Prices will spike violently. Second, watch the US dollar index. Silver moves inversely to the dollar. If the DXY breaks below 100, silver will rally hard. Third, watch central bank gold purchase reports. The World Gold Council publishes monthly data. If China announces accelerated buying, that signals broader de-dollarization. Silver will follow gold higher. There are 3 types of people watching this right now. The first type is panicking. They sold at $75 and are waiting for $50. They will miss the entire recovery. The second type is frozen. They bought at $110 and cannot decide what to do. They are paralyzed by uncertainty. The third type is learning and preparing. They understand this was a leverage flush, not a fundamental breakdown. They are accumulating physical metal at discounted prices. Which type are you? Here is what you need to understand. Markets do not move wealth randomly. They transfer wealth from the impatient to the patient, from the uninformed to the prepared, from the emotional to the analytical. The January 30th crash was designed to shake out weak hands. It worked. Retail investors panicked and sold. Institutions stepped in and bought. This happens every single cycle. The only question is which side you are on. Are you still holding silver? Because what happens in the next 90 days could determine whether you profit or panic.
If this breakdown helped you understand what actually happened, hit that like button right now. Subscribe if you want to see markets clearly while everyone else is confused. And share this video with one person who is panicking about their silver position right now.
Drop your answer in the comments. Are you buying this dip or waiting for lower prices? Let me know.